Hello, this is Coach Mike. We're going to start talking about the focus group spreadsheet. You're going to see that based on a couple of our recent lessons, there might be some confusion in the charts. Why? Well, let's just take, for example, this chart on Apple. Looking at this right now could be quite confusing. Lines all over the place, right up where the current candles are. And each one of these lines is important for a different one of those trades I have listed. So we're going to break this down very, very easily for you to be able to understand every trade that's on our watch list for the focus group this week. So to start out, as you can see, I've tamed down this 1 year daily chart. And we're going to take a little better look by going to the 6-month daily. And, using a couple points first. Where does this red line come from? Well, it's a Fibonacci extension line where I started at this high on July 16th. I went to the low on July 17th and marked up to the high of July 29th to say that after making the up move from the low on the 17th, if it were to replicate the down move made prior to that, where would it go to? It said 95.04. Well, it almost went there. It just went just a teeny bit below it. So we're just kind of going to look at that as, hey, that got us in the general area. Now also you see this trend line. I started over here on a low, I connected to the last low, and ironically, that hit Friday's low of the day on Apple. Now, a Fibonacci extension set that I've had on here for a while, marking from this low before this big run up to the low after a fairly decent pullback, still gave us a projection of $101.80 for a higher side swing target. But, we've been making some ups and down moves within that. So it gets really, really easy. I listed the support of 94.81 on the chart. That was your low from Friday, but really, it's this trend line. This trend line on the chart is going to give you an idea for where your stop is. Each day that goes by, your stop will be higher. And this is for the September 20th 100 calls, the first trade listed on the Apple spreadsheet, or the spreadsheet for Apple. And this is just one of many possible trades. But I wanted you to clearly see we've got a trend line touch. If you're trading the trend line, that's all you needed. If you use Fibonacci extensions, well, this high, this low, this high, said we could only expect it to come down to about 95.04. That's what it did. And we'd be looking for another high side target. And you could actually very likely with that also put in Fibonacci extensions to this other point to say, you know what, well, if it doesn't go all the way up to 101.80, where could it go? And you see this set almost gets you to that 101.80. So I chose to just leave that one off my chart because it's the same area. It was 101.75, so too close to clutter it up. But easy enough if Apple continues upwards in the morning. Now you'll see that, the entry target, I say less than 96.50. Well, what I'm factoring in with that more so than anything else is that the prices I put for the expected price you'll pay, the estimated risk, and the estimated reward, that's factored on. I have to put a number in there. That doesn't always mean, hey, if you missed 96.50 and now it's sitting at 97 and it definitely looks like it's going to still go up, you can't enter the trade. It just means your risk might be a little higher, your reward might be a little smaller, and you might be paying more than what I estimated you would pay. And that's important to understand there. But one thing that is very important is if your support fails, you don't necessarily need to be in that trade anymore. For the next trade on Apple, I want to start with showing you where I got the Fibonacci point from. Point number one was derived on my weekly chart. You can see that the last real Apple pullback began from the high on December 2nd, went down to the low on January 27th, and then assuming that the high we saw last week would be the high. Now let me move that over to the daily 6-month chart, and you'll understand now where this 87.78 Fibonacci point came from. Now, if you look at the spreadsheet, I say it supports 92.57. Well, just above there, you said it was 94.81. How you should read that is, oh, it must have to fail something, or that calls trade is only good down to 94.81, not 92.57. And now we're going to talk about the 920 $90 puts. You'll see that the resistance I have listed as 95.04. That would be if it failed this trend line, the same trend line I was talking about for the last trade. If it failed that trend line would become your stop, and you would be looking for this Fibonacci target at 87.78, in which case I think you'd be okay to play the September 20th $90 puts. So we have two different potential swing trades to watch for this week, both really largely based on this trend line right here and whether Apple stays above it or goes below it. In our swing trades off of our daily chart, we'd want to be out in September now when we're basing them off of our daily chart. Okay, now we're going to move over to the 60-minute chart. The next trade I have listed for Apple, the next potential trade, is still using the 94.81 support, looking for an entry under $96.95 on the August 16th 98.57 calls. Now, the target area 99.08 is based on this Fibonacci extension set. I went from the low when it gapped up after earnings to the high made after earnings to this low if making the assumption that the low's been made because it came down and about filled this gap. And if so, the reason I like the 98.57 calls is for the price. They're better than anything else to still get us to our target. Now at this point in time, you'd want to get in lower than 96.95. That's the 50% line. If you're trading the Fibonacci extension trade system that we've talked about in recent lessons, and if you're doing that actively on Apple, you need to be in this trade. And you don't want to keep letting it go without getting in it, because you could let it go too long and maybe take a puts position but see it come right back to validate your calls position. Remember, you got to buy those trades when you see them if you're going to actively trade the trade system of Fibonacci extensions on the 60-minute chart, which is something we've talked a lot about in the last couple weeks. So there's the chart and the Fibonacci's I would use for that potential trade on the August 16th 98.57 calls for Apple. Okay, and up next you'll see a potential trade on the August 16th 95.71 puts with a target of 95.03. Now I just looked at recent moves here. I marked from this high to this low to what was actually a higher high, and it gave me 95.03 as a potential target area. It's more than $1 move from the highest line to the lowest line, so it could give us some potential for those trading the Fibonacci extension trading system on Apple's 60-minute chart. And very, very simple to follow. If it broke above that line, then that whole Fibonacci extension set would be nullified. You'd have to delete it off your chart because you go above it and your zero line would be wrong. Very, very simple, easy to follow, but I wanted to do them individually where I broke it down on the chart to show you each individual one instead of that big, nasty, messy chart that might confuse you. So you can see here, marking from the high Thursday at about 2:30 to the low Friday morning at the open, and then to Friday's high of the day made there at about 1:30 in the afternoon. It gave the potential pullback area of 95.03, and that's where the trade on the 95.71 puts came from. because this isn't a very big move, I'd want the higher strike puts than just like a 95 or even anything smaller, because even though they're more expensive, there's a better opportunity for them to go in the money quickly and move more fluidly. Next on the spreadsheet, I have the August 16th 92.14 puts. Now, how I came up with that strike was in this 91.99 100% area target is I quite simply moved from this high, viewing this all as one down move, to this low, and then should Friday's high of the day been the high, and it continue to pull back from there. Now, if you watch the video lesson that we did a couple weeks ago on the 60-minute chart for Apple and watch the Fibonacci extension video, you'll see why each one of these is individually important. And that's a big thing to understand. Now, the next trade that I've put up there, you notice the 822 $95 puts. And all my Fibonacci extensions are gone. Why? Well, we also discussed in that lesson on Apple's 60-minute chart that even though I liked the Fibonacci extensions better for me personally, there was also a lot of success on a progressive channeling system. That channeling system, you know, hey, you got a bit of a, not quite, but looks like a bit of an evening star here, a lower high after a lower low, and if we connected the tops and ran that parallel channel line for a bottom and marked where we would be if we hit that immediately at tomorrow's open, we'd have to go to where the 9:30 candle would be, and this is how I project with my channels. I know it's going to probably take more time than that, but I check that way. You see I had like 94.43, which is the area of that bottom line, and 3 weeks out instead of the 2 weeks out from the fib trades, because if you watch that progressive or advanced channels video on Apple, we needed to be 3 weeks out in the study because of how the trades worked out. So this channel, as you see it here on my chart, would be what I'd look for if trading the progressive channeling systems on Apple 60-minute chart. The final trade I have listed on Apple is for the 822 $100 calls. And let's look at why. Well, after the earnings made that move up and it's pulled back. Okay, well, it had good earnings. That's reason to believe it could go higher. So I marked a channel line's bottom between these two lows and ran the parallel up on this high. And why did I pick the $100 calls? Well, if you look, if I went straight up from that day to where it could hit, I'm looking at about $100.28. So the $100 calls would put me in the money at that line. Why do I do it there? Well, yes, I know it'll probably take more than one candle to get up there, but man, wouldn't that be great if it got up there in one candle? And because of that, if I budget low, I should be better off in the trade than going, well, you know, if it takes 29 and a half candles to get up there, then maybe I can go with the 101 call or something. And then what you end up seeing is making up moves while you're holding calls, wondering why you're losing money. I'm just budgeting low to here, knowing that each candle that goes by gives it a higher resistance area. Makes it really, really simple. This would be with using the progressive channel systems, the advanced channel video that we did 2 weeks ago with Apple, 60-minute chart, and trading 3 weeks out because the study showed that that was where we needed to be. So now we're going to move over to Caterpillar. And the first trade I have on Caterpillar is dependent on this weekly chart. Why the weekly chart? Because those blue lines you see indicate some swing points that have been very, very important for Caterpillar over the past 7-8 months now. We saw this lower level consolidation, we broke above that swing point, and things got nice. We got right up into this swing point, we gapped over that swing point, and things got nice. We were headed to this upper swing point, but just didn't get there. Now, even though Caterpillar beat on their earnings, they had some guidance things that raised some concern. And then to add to that, the markets were pretty weak last week, which give them some more downturn. But if you look, you just pierced this swing high point and still closed above. And now that weekly chart's looking like a W that just retested, isn't it? Looking at that, I think because it's the weekly chart, you got to give yourself a little more time than just going September. So I put on there the October 18th, that's the October monthly 110 calls. Now with the target at 116, you could probably get away with the 115 calls. But what the 110 calls do for you is they're still right now under $1, and I project you could get them under $1. And if you hit the 116 target, you have $6 of intrinsic value, which would mean even on expiration day, if you're at 116, you'd be selling those for $6 or a 500% return or more on what you pay for them. And all you got to do is close your weekly candle above that blue line. Now, because it could go below that blue line and still close your weekly candle above it, we've also got that trade for the $90 puts for the October monthly. Why the $90 puts? Well, comparably close enough in price for the expected entry area, but if it were to fail this line, you would have to look at your next swing point line as your target, which is $88.62. So the $90 put would put you in the money should you drop down to here. And that way, if you made the entry on both, if you just entered it as a strangle here, knowing that if you hit your target on those calls come October, or even before then, you're going to at least make 500% on your money. And that if you were to fail this line, you have to wait all week to see where the weekly closes before you exit out of those 110 calls. You might want some insurance. This is a very, very easy to see and explain trade for Caterpillar. And I'm telling you, if you enter this trade, you're entering it off the weekly chart. So if you're looking at your 5-minute chart and your 15-minute chart and your hour chart and your daily chart, and only in this trade that I'm talking about now, you're messing up. Because until the weekly candle closes, there should be no questions on what you would do with that strangle position. Moving over to CVX now. You know, we saw those oil and gas stocks have a decent drop, even though CVX did well on earnings. COP didn't do bad, and XOM actually did good on earnings, but they dropped with the markets. CVX dropped right to the swing point and bounced up from it on Friday. COP, I had a trade in that. I was looking for $80 area for puts. It hit the $80 area. Cool. A lot of these stocks drop down to where you might want to go long on them. But you see, it did make a lower low from this low before the last high, which is why my target area would be 133.43. And based on prior chart studies of CVX, you may want to wait until the end of the day when you may be able to confirm a morning star, which you would need the whole day to do that. Otherwise, you could just guess it might make a morning star and maybe get lucky and get a better price. But you'd have to play the 130 calls. And I would right now go out to September, because we're planning it off the daily chart, the September monthly. And they're going to be a little bit pricey. Yeah, pricier than most plays for CVX. But right now, until CVX really establishes something, I don't want to rush into anything. But I also don't want you to miss potential if this is one of the charts you're trading. And one of those potentials is if it makes a morning star after bouncing off that swing point, you want to make that trade. Because the worst thing that can happen is you stop out and the risk is already outlined there for you. But it's a lot worse to see a trade that you identified as having potential do exactly what you thought it was going to do, and you watch it do it the whole time without ever being in it. When the worst thing that can happen is you may have stopped out of it had you made it. On now to Facebook, FB, kind of like that Apple chart, lots of lines on there, and I don't want to confuse you, and I've got a lot of potential trades listed. So what I want to do is I'm going to clean those off of there, and I want to explain each one of those trades to you individually. So now that's a lot better, isn't it? What we're going to do is we're going to take a look at some things on the Apple chart over the last year and things that happened on it. Now the chart I linked in there had a little bit more on there that I did take off because it's just to explain things to you. You see, last year before the July earnings, Apple was sitting about 25, 26 bucks. And it gapped up here and it ran for a few days up to just shy of 40 before making a $4 pullback. And then it very, very gingerly went upwards until the first really good candle was it gapped over the swing high that was made after the earnings. Now, let's fast forward this a little bit to the point where after getting the confirmation of allowing it to break the swing high made after earnings, it ran 38% to the high. And let's look at the next swing point that it did here, where had you waited for the break here, even though it just kept bouncing off that swing point, to the high, it made a 32% run. And now here you are, yes, it's run up from the bottom, but you've got a new swing point established. The highest daily close is the stop line. Quite literally, you could either look at this as, well, it rested right on the prior swing high, or it nearly filled the gap, or you could wait for it to break that point, at which time you would look at the fact that it already did a 38% run, a 32% run by doing the same thing, which is breaking that swing point and budgeting low like I always do. I only used a 25% move. That put you at $90.03. Now, because the price of the options and playing for such a high move, I actually decided to not go too shy of where the target was for the strike. The December 20th $90 call. Why? Because I don't think you'd be holding it until December. I think it'd be something that ran up by October, if it was going to make that trade, and pull back again, much like it did last year. So the extra 2 months, even though you're paying more for it now, gives you the ability to kind of let it rest so long as it doesn't hit your stop. And also the fact that I only budgeted for the 25% move and not the 30% that it made in the past. The next trade that I have marked is for the 920 7750 calls. And where I'm getting that at is actually not on the drawing that I left there. So let's skip that. We'll go back to it in a second. This would be the drawings to use for the 920 $80 calls. We had a fundamental change on the earnings break, or our earnings beat. Okay, so it jumped up, but it came back and filled the gap within a few pennies. So if it were to make a positive move on Monday, we would be looking at this channel and the bottom line being our stop, and that's a pretty steep line, which means if you were going to get stopped out of it, it's either got to move or you're going to get stopped out, but each day your stop gets higher, and it gets a lot higher on this channel. And the reason the $80 calls were chosen is, if we go straight up here from where the entry would be, we'd be right at about 80 bucks, knowing that it's probably not going to get there in one candle. We can use that for, hey, every candle that goes by, that high gets higher, which will put us in the money and further in the money. So I'm sorry I got a little mixed up when I was redoing the drawings. This drawing set here would actually be for the 920 $80 calls, potential trade off the list. So here we go. Now we'll talk about the chart used for the 920 7750 calls. Now, still playing on the gap fill, but you also have to kind of recognize we did pull back from here, giving us potential channel, and if that was going to be so, its parallel's way down here. But if we were to bounce off the swing points here and basically double top on the channel, 77.50 is an area we could look at for a calls trade. Now, one thing I would look at here is that this trade may only be best as the leveraging side of a strangle if it starts to qualify more for one of the other trades I have listed. And that's what we're going to talk about next. Going right into that, the 920 $60 puts. Why the $60 puts when you're talking $80 or $77.50 calls? Well, notice the channel that I have here. Notice where the bottom line of that channel is. There's a lot further to go to the bottom. But if you were to go back to the top, to be able to really know you'll make money in those calls is to play calls that would go in the money, and that would be, around those $77.50 if we were to get that bounce. But your $60 puts would be what would be assumed to go in the money should you come down to this bottom channel line, which, okay, it's hard to imagine that it could fall like that after really good earnings. You know what? 3 months ago, it actually at that time had its record earnings. And it fell even harder than it trickled down this past week. So if you use the market overview video and watch for some support levels on the S&P 500 or that comp chart, COMP, no stock is stronger than the indices. When the indices pull back hard and fail support, stocks will too. And that could be something where even if Facebook was strong, it could still go all the way down here. And from the last earnings to the present earnings, 3-month period, the earnings period, could still make a higher low than it did last time. So if the indices fail support, this might be somewhere you want to look. Okay, moving over to First Solar now, FSLR. They have earnings on Tuesday after hours. So there is some inflation on those premiums. Just understand that it's a bit skewed. You may want to look more at this for an after earnings play. Now, First Solar back in March had that great big run up. And believe it or not, we had an alert that caught that run up. I just sold a couple days too soon. But after that great big day, who wants to risk it pulling back some? And since then, it's made what I'll say fairly small moves for it as it seesawed its way down. And I started saying then, I'm going to wait for First Solar to come back down to this trend line. And I had people say, no, Coach Mike, it's not going to do that. And even though there was some money to make on up and down moves, this isn't one I've really liked playing puts on, because as you can see, I was right. It came down to that. But that would have been one stressful puts play, right? All these up and downs, up and downs, up and down. This great big up where it looked like, ooh, Coach Mike might have been wrong. But then it came back here. That would have been a big pain in the butt as a puts play, which is why I wanted to hold off on it. Now, you do have a couple potential plays here. I listed calls plays because as long as we're above that channel line, that's what you want to look at. I think it's a no-brainer on a short should it fail that channel line. I mean, look at these great big moves it made off of this channel line. So if it fails that channel line, well, that's definitely going to be a change from what it's been doing. But one of them I have listed that you could probably take even before the earnings is the December 20th $80 calls. Quite literally, all it has to do is hold that channel line. Because then by December, it'd be expected that it would get up to this. Now, I guess you could go with 85s, but that's pushing it a little too close. The $80 would already be well in the money should that upper trend line be hit. Now, still on this chart here, I want to look at the 920 $70 call, which I mentioned. Now, if you see the left side of a W, it came down, it had a lower high. Now, if you were to buy this now, I've got the prices, you see the prices for what you could possibly get it at now. But I talked on the spreadsheet about $66. Where this would be is, what you'd have to hope for is Monday it doesn't make, or Monday and Tuesday make the big up move to already get to the W. If it does that, it could throw it out. But, if the earnings comes in after hours on Tuesday and it gets it to the point suitable just above this line to break the W, you'd be trading to the first close at the start of the fall, 71.06, and the $70 calls could be an after earnings trade. Now understand, that'll make the prices much different than what I have listed. Probably about half for the September 20th $70 call. So then you have to look at it too and say, well, if it's going to make it about half, is it really worth me trying to force my way in it now when if it doesn't do it, if it doesn't beat on earnings, then I've got a lot of added risk. And quite literally, for what I'd pay for it now, I'll probably be paying pretty comparable to the same price, even if it runs up to the W. If that run is after the earnings and not before the earnings. So that's what I'd watch with First Solar. Now, if it starts making that move towards the W early tomorrow, you could take that trade now and maybe sell it before the earnings, because it would suck to see it get up that much and earnings come and oh shoot, it missed and now I'm losing on a trade that was a winner. Or at least sell half of it or some of it where you're just riding free contracts. But because it has the earnings, I personally would rather wait until after the earnings to trade it. The solars can be quite weird for their earnings, so I wouldn't force it. GLD, we've talked about this horizontal channel on GLD for some time now. You're basically right in the middle of it. You can strangle out 2 to 3 months based on strikes just below this line or just above this line, and it's been pretty successful of a trade system overall. You start reducing your position when you break the line to either direction. Very, very simple. And because you're right in the middle of that line, might be a good time to look at that strangle entry. The good thing is there's been quite a few times where it makes the break above the line and comes back below the line, where if you are trading out the 3 months, you could have opportunities on both sides of that, which is even more fun when that happens, to make money on both sides of a strangle. Even though when it returned back into the channel, you'd have been buying more that were out a little further. And then where those puts made money here, the calls that were down came back and made you money as well. So GLD, this right now until things change, that's the best way to trade GLD, is to buy the strangle when it's within the horizontal channel. Sell half when it exits the channel. Sell the other half when it looks like it's going to start moving the other direction. When it's back in the channel, re-enter the strangle. And always hold your losing side on the strangle, because you never know when it'll come back the other side. And just so if you're wondering about, well, is that enough of a move? When we talked about this a few weeks ago here, wasn't even on the doji day, it was just here, hey, it's back down in there, you might want to buy. 2 days later, the calls were up 124%. Which means even if you lost 100% on the puts, you still made 24% on the overall trade. And if you look, it didn't even move that far out of that horizontal channel. On over to Goldman Sachs. Now, right now, I've only got one trade listed on this. And the reason is, I trade Fibonacci extensions on Goldman Sachs daily chart. That's what I've always used. It's been successful. If it ain't broke, don't fix it. And that's what I use for me. Well, we're getting close to the 167.92 pullback target. Remember, these values aren't, it will bounce exactly off of 167.92. It's a general area to watch for. General area. So whether it happened tomorrow or the following day, that 167.92 would be the stop area. Like if it started to make an up move tomorrow, okay, we might want to buy some calls. But sadly, we have to recognize that the trade system still said it could come down to here. And that's where we'd want to look at those September 20th $180 calls. for that potential move to be made. And it would be to get us right back up into this all-time high area, about 181 bucks. Right now, Lockheed Martin's been acting real funny, and it's not because it's not a good stock. Their earnings were phenomenal, but the rest of the sector's been getting beaten up. I have it listed as no new trade right now, and I suggest that you stay with no new trade. Next up, UPS. You know, what's funny about UPS is when I just look at the chart, it looks to me like it needs to bounce and it could make a good bounce. I see an M pattern. If you look at this high and then this high, looks like an M, and I could see it retesting that about $101, which would be about a $4 move. It would be a little bit risky for you to trade for that, and that's why I have it on the spreadsheet as no new trade, because, you know, maybe if it would at least give us a morning star, we could say, oh, now we could trade on the continuation. But if you're willing to take the small risk on that potential that it at least gets back up to the M, the middle of the M, which, where do you buy an M? When it fails or when it retests it? Well, this one gapped through it, so you have to wait for the retest of it. And that's kind of what I'm waiting for. I'm waiting to see from here, does UPS give me a lower low at some point? Does it make a little move and give me a lower low, lower high, whatever? You know, a lower high that says, oh yeah, now we go short. Or does it come up a little bit, pull back, and give me a higher low to say, you know what, the earnings weren't as bad as what you would think after seeing the chart. So could it actually just, you know, people sold because they sold and it hurt the stock and now it has a chance to go up? And I'm confident enough to say that when it does that, if it was going to go up, it'll give you an entry that you don't need to worry about the low, especially with buying options, because look over here. Yeah, you could have bought this low here, but 2 months later, by the time it actually broke out of consolidation, you were better off buying the same contracts on the consolidation break that you would have bought at the low. And all you would have had was to say, well, I bought the low. You bought the low, and $6 later, we're at break even when it finally broke out of consolidation. And that's why I don't have a trade listed here for UPS. It's actually the same reason I don't have one listed for Visa. I thought that if Visa would have beat on earnings, we still would have pulled back because it had run so much, and that we would have a lower or a higher low entry point to make. Sadly, their earnings were not good. And because their earnings were not good, you had this bit of a fall, which Friday had a decent day. Now we've got to be watching for a high to go short on, and that's just how trading is. I mean, you can try to force it with no rhyme or reason whatsoever. I mean, there are trades you could enter just for, hey, I think this could go up, but not having an idea where it could go up to due to the fundamental change. You could watch the high happen and not know it's in until you are looking from or at it from well below it. And because of the fundamental change, I think you got to let the chart sharpen up a little bit to give you a higher probability trade opportunity. So a little bit of stuff for potential in this upcoming week for the focus group, but in all reality, a lot hinges on what the markets do this week. Let's not get too dead set on seeing some of these trades on this focus group spreadsheet and convincing yourself that you will enter one of those. Because if we come out tomorrow and a lot of these that fell right to support points are below those support points, it changes everything on that list. And that's what we've really got to be watching for. More so because I actually think the markets could make a dead cat bounce. And sadly, I think that dead cat bounce could be very convincing for people to say, oh, it's bottomed, it's bottomed, it's bottomed. And because they won't be expecting it only to be a dead cat bounce, they'll miss the sell. For me, I'd rather give it the dead cat bounce. Let it make a bit of a retracement. And if it continues strong, use that as confirmation that it's not a dead cat bounce. And look for those entries. Some people would call that chasing. I would only call it chasing if it wasn't exactly what I'm planning to do and already understanding what the risk is on it. Whereas, okay, I could make buys and have to hold for a little bit more of a fall, but have a little more confidence that it will make higher highs. And that's just how it goes sometimes in a trader's life.